Hello and welcome to Street Signs on this Wednesday. It's a big day, almost time for the Fed decision. We are expecting it in just about 15 minutes. We have a series of live reports and special guests for you today on housing, the markets, bonds, as well as former San Francisco Fed Governor Robert Perry. Let's get started. Like everyone else in America, the Fed is trying to figure out what's up or what's down with the housing market. The run-up in housing was unprecedented, so no one truly knows how tough the pullback will be. Our Diana Olick is here with the very latest from the housing market. Hi, Diana.
Hi, Erin. And today we've got the weekly mortgage application numbers out. And while they don't use...
Thank you very much. So now Diana's given you a sense of the numbers here. Let's talk about what it means for the economy and for the Fed. What does housing truly mean for the Fed's decision today? Maury Harris is the chief U.S. economist. We do appreciate it to give everyone just a sense of how big housing may be and just how divergent the views on Wall Street are right now about what the Fed may do next and exactly when. The markets right now, though, are rallying coming into the Fed decision. We want to show you this chart so you get a sense, and we're going to monitor it as we come through the decision as it crosses. The Dow up about 78 points, the NASDAQ up 1.5%, continuing to be the leader. The S&P 500 is also in the green today. Now, up next on Street Signs, we are going to count you down to the decision from Fed policymakers. We have a panel of experts for you, and then later, once we get the decision, we're going to tell you what it means. We're going to talk to one of the guys who used to be in the room as the Fed made its rate rulings, former San Francisco Fed President Robert Perry, in his first television interview since leaving the Fed. This special edition of Street Signs will be right back.
Maria Bartiromo talks to former President Bill Clinton on global tensions, the midterm elections, and the Clinton Global Initiative. Closing bell tomorrow, 4 Eastern on CNBC. What?
Well, the Fed will be making its interest rate decision in just a few moments. We have a preview now from our panel of experts. Bob Pisani's at the New York Stock Exchange, Rick Santelli at the Chicago Merc, and then here on set, senior economics reporter Steve Leisman and senior analyst Ron Insana. Now, coming into this decision, we want to give everyone a sense of the markets, really a rally across the board. Treasury yields at their lowest level in 6 months, stocks rallying. So let's get that side of the story first. Bob, what are you seeing?
Well, first off, the Federal Reserve is a non-issue down here, Erin, on the trading desk and on the trading floor. I think that's a bit of a mistake. The few people who have brought it up to me have been surprised by that and think there's a little too much complacency out there. And even a little bit of hawkishness on the Fed might surprise the market. But the bigger issue down here, Erin, is this growing tension between the bond market, commodity market, and the stock market. The bond market is moving up. The commodity markets are moving down. They seem to be telegraphing a bit more of a slowdown in the economy than the stock market wants to acknowledge. We're at new highs in the stock market, and yet it hasn't resolved that tension with bond and commodities. And even in the stock market, we're seeing some real tension. We're seeing stocks that go up, stocks that go when the economy moves down. We see some of these stocks doing better, like consumer stocks, but they're doing well, too, in addition to the cyclical stocks.
And Rick Santelli, I mean, we got yields at a 6-month low. Is that fair to say? What is the bond market pricing in terms of a slowdown right now?
Well, you know, it's hard to say that the bond market is pricing a slowdown in the aggregate. I'm sure there's buyers in treasuries that have purchased because of that. There's also buyers in treasuries that are buying because...
The Federal Open Market Committee decided today to keep its target for the federal funds rate at 5.25%. The moderation in economic growth appears to be continuing, the FOMC says, partly reflecting a cooling of the housing market. Readings on core inflation have been elevated, and the high levels of resource utilization and the prices of energy and other commodities have the potential to sustain inflation pressures. However, the FOMC says inflation pressures seem likely to moderate over time, reflecting reduced impetus from energy prices, contained inflation expectations, and the cumulative effects of monetary policy actions and other factors restraining aggregate demand. Nonetheless, the committee judges that some inflation risk remain. The extent and timing of any additional firming that may be needed to address these risks will depend on the evolution of the outlook for both inflation and economic growth as implied by incoming information. Once again, there was one dissenting vote on this overall policy decision. Jeffrey Lacker, who it says, according to the FOMC, preferred a 25 basis point increase in the federal funds rate at this meeting. This is Hampton Pearson reporting live from the Treasury Department.
All right, there you have the decision, and we just want to briefly tell you the reaction in the equity market has been a bit of a pullback. We were up 83 points as we came into the Fed decision. Right now, only up about 67. Three major changes appear to be in the statement. They do take away the word gradual when referring to the cooling of the housing market. Also, basically unchanged through the readings on core inflation aspect. However, they did also mention inflation pressures seem likely to moderate over time, reflecting reduced impetus from energy prices. That was an addition and contained inflation expectations. Also, the other thing that stayed the same here was Jeff Lacker once again dissenting and preferring a quarter-point increase. So, Ron, what do you make of this?
Well, Aaron, it's interesting that they mention energy by name insofar as the real question is whether or not some of the recent run-up in energy prices had to do with geopolitical issues, strong demand, or some leveraged bets in the commodity markets that went bad. As those are being unwound, we're seeing energy prices come down. And when you look at gasoline across the country, you're starting to see headlines in various papers, particularly in some smaller states, that gasoline is beginning to break below $2 a gallon in some places, even though it may be $2.50 in New York. And so that's a tax cut for the consumer. It is also taking some inflation pressure out of the economy. And the Fed, by specifically noting that, kind of reverses course on the worry about the energy pass-through in inflation that they'd mentioned so many times before.
Rick Santelli, Steve Leisman said right before the statement crossed that the crucial thing about the statement was, would it be dovish enough? Is it?
Well, Steve is definitely reflecting a good chunk of what's trading in terms of investor attitude toward dovishness, inflation expectations. But I have to tell you that most of the traders still believe that the story is more about a moderating economy. It's more about lackluster job growth. It's more about the cottage industries related to housing. And if you look at the markets, it's as though everybody had it pretty much right. They were all long, whatever market you're looking at, just a smidge of profit taking, yields up off their best levels. But there are no surprises here. As a matter of fact, if you look at Fed fund futures, they hardly flinched. Investors look like they're grabbing into the story pretty much in the same way the statement was almost identical in many ways to August 8th.
It truly was. Steve Leisman, identical to the bottom line that Jeffrey Lacker once again dissented.
Yeah,
well, why is he being so stubborn?
He's getting beaten 10-1, though, so it really doesn't matter.
There's a considerable contingent out there, and I think there's even a little bit of a contingent on the Fed as well, who think the Fed is simply too loose, that the real Fed funds rate is still stimulating the economy. It looks at these low long-term yields and says the Fed is not breaking the economy enough. It looks at things like labor compensation. I think this is what we're going to see in the minutes coming up. I was interested, though. I thought one of the big questions going in, they removed the gradual on the housing thing, as you said. But look, the Fed's bias is still a tightening bias, technically. Now, Rick is going to come on in a second and say, watch the walk, not the talk. But the talk is still that the extent and timing of any additional firming, that tells us that the Fed has a predilection now to hike more than it does. We're still technically, in the words here, in a pause mode here, not on a hold or en route to a cut. That's what the words say.
And some of the smarter people I've talked to said the couple things we want to watch. Number one is going to be employment and the wage component, which has now obviously grabbed the Fed's attention, as we heard resource utilization does as well. One of the things that I've been worried about was the resets on all these option arms, interest rate only arms. And I've talked to some people who say the bankers are now going out and very actively talking to people who are maybe in trouble of being reset in 2007 and facing an accumulated interest rate payment hike and principal payments that will begin at the same time, and maybe stretching those loans out, restructuring the loans right away so they don't see higher defaults next year.
Right.
So that may take a little pressure off the Fed if they were forced, let's say, otherwise to ease so that people could refinance out of those problems. So I think there'll be a mix of variables that the Fed has to look at going forward, and it might be a softer landing than some people would expect.
And we're going to talk much more about what Ron just said, because we have the CEO of one of the largest mortgage companies in the country, IndyMac, coming up. But I want to give everyone a chance. Go around, round robin, 10 seconds each with your bottom line takeaway. And Bob Pisani, let's start with you here.
Well, bond market yields have come up a bit in the last 10 minutes, but the stock market is essentially just below the highs that we saw. I still believe that equities seem to be a little bit out of sync with what the bond and commodity markets are telling us, Aaron.
Rick?
Well, I think that the Fed's going to get as much mileage out of the words in the statement because they are probably a little remiss to tighten anymore and see a bigger inversion of interest rates towards Fed funds, which could be interpreted as some type of recessionary indicator down the road, a bit of between a rock and a hard place.
All right, bottom line here from Ron and Steve. Steve?
I think the Fed, in the split between the Fed and the bond market, where the bond market is 2 quarter points away, 2 cuts away from where the Fed is, the Fed took a baby step towards the bond market, but there's still a gap there in terms of where the Fed is leaning and what the bond market expects. I'm not sure that the twain are going to meet anytime soon here.
The tightening bias. And
yeah, well, I think the employment data will be key going forward. I personally have thought for a long time the Fed's done. I still think they're done. There's a risk of maybe one more tightening out there, but I think that might upset the apple cart. I still bet they're completely with the tightening and they ease in 2007.
All right, fascinating. We'll see what happens. Everyone, thank you so much. And that is our panel of experts there. You've got the Fed decision. Now we're going to break it down. Just ahead on Street Signs, we've got the view from inside the meeting. Former San Francisco Fed Governor Robert Perry will join us, give us his take on the Fed's actions today and what comes next. The trillion-dollar question. And then the 2 biggest bond fund managers in the nation, PIMCO's Bill Gross and Vanguard's Ken Volpert, will weigh in with their views. Our special edition of Street Signs rolls on.